day today, in that the data that is coming out later in the evening today is very, very crucial. Simply because while monthly inflation data otherwise need not necessarily be very important in today's session, because this is coming in just 4 or 5 days after the payrolls data threw up the surprise. It's something that people are watching with bated breath. So this plus Trump presidency plus lots more. To talk about all of that, Jonathan Schiessl, Deputy CIO of Westminster Asset Management, joins us all the way from London, I presume, or yes, it is London. Jonathan, good morning to you. I hope all is well.
Good morning. How are you?
Yeah, very, very well. Thank you, Jonathan. What's your sense about the importance of this data, considering the fact that the number of rate cuts, the expectations have gone off completely? Does this number have the wherewithal, if it is very high, to make the markets believe in the opposite, which is that we might not see rate cuts at all this calendar, or at least the first half?
Absolutely. I think you're quite right. We've seen a huge amount of volatility and changing expectations over the last few months with every single data set that we seem to be getting. As you rightly said, the labor data was extremely strong late last week. And this number is being very keenly followed once again. Obviously, expectations, you just have to look at US yields where they've gone. They've risen extremely sharply, as has the dollar, in response to the market now believing there'll be, no rate cuts potentially next year. So you're absolutely correct. This is a crucial piece of data again. And obviously, expectations still are somewhat confused about what the new incoming US administration will actually be doing with regards to potentially inflationary policy with tariffs and stuff. So there's a lot of uncertainty, and that's making the data even more important in the short term.
Right. Jonathan, Harsh also joining in, we've entered a phase where we are anticipating rate cuts, or the market is pricing in rate cuts, but it's not coming through. At what point do you think, what are those 2-3 key factors? Of course, inflation being one, but if you can even give us a number with regard to inflation, would it be 2%? Where would the Fed be tempted to move with regard to where rates is concerned?
Yeah, it's very difficult to get, numbers, actual concrete numbers. I won't go down that road because, clearly we're not quite sure. But I think, the Fed at the moment is in a very tricky place. There is, the economy is still showing remarkable resilience in the US. But a lot of people are talking about that and saying, well, perhaps that's because a lot of US borrowers locked in lower rates a couple of years back. And as that begins to come off, those higher rates will start to impact the underlying economy, and the economy therefore might slow down at some stage later on this year. So the problem the Fed can see is there is a potential slowdown on the way as these rates start to bite. But on the other side, you have a new incoming administration that potentially as well has some quite inflationary policies. So there's so much uncertainty for the Fed at the moment that it's quite they're going to have to just sit back for a moment, talk tough, sit back, say we're going to hold rates, and then they've got to sit back and see what actually will be happening with regards to policy. And then the other clear important point would be energy prices. Obviously the new administration is talking about improving productivity from a US perspective, pumping out more oil. But clearly, oil prices have begun to move a little bit higher again. And that's obviously inflationary again. So there's lots of different factors at play here. And therefore, that's probably making the Fed to just sit back and just see what happens. But in the interim, obviously having a slightly more hawkish tone.
Jonathan, just one question from my end. The market seems to be bracing for the worst of inflationary data with the presumption that tariffs will lead to inflation. And yes, they will. But the extent of tariffs that the market seems to be baking in right now, considering how the 10-year is behaving or the far-dated yields are behaving, right? My question is, could this be an extreme form of pre-positioning ahead of Jan 20th? And could the event being out of the way reverse this trade, even if not permanently, but reverse this trade for a bit of a relief rally of sorts in the very short term, let's say from Jan 21st until maybe mid-Feb or thereabouts?
Yeah, I totally agree with you. I think personally markets in the US and certainly you look at the UK and stuff, I think markets probably are pricing in a sort of definitely a worst case scenario. And I think, the incoming US administration, they do not want to see inflation running away because that's obviously will be very damaging for them. So I think I would absolutely agree with you that potentially there is some relief once the new administration does come in. And it's, at the moment we're seeing sort of sell the rumor and then it will buy the fact or vice versa. So yeah, I think you're right. There's definitely markets to our mind have certainly probably pushed up a little bit too far and are pricing in to an extreme environment.
Jonathan, quick couple of questions. One is with regard to where you see the dollar move on the back of the environment that's building up. You seem to be already resigned to the fact that the CPI number will, in all likelihood, be a bit of a disappointment, if not, clearly not a beat, is not what you're penciling in, it seems. And therefore, where does the dollar move on the back of that? Second, bond yields have seen a spike. Where to from here? We've not seen these kind of yields since 2023. And therefore, what should one expect on the bond yields front and therefore on flows? What's your sense?
Absolutely. So the dollar obviously is, driven by many different factors. And certainly sitting here in Europe, when you look at growth differentials between Europe, including the UK and the US, and that's obviously driving a lot of flow out of European markets into the dollar. Obviously, as we've just been discussing, the outlook for US interest rates looks a lot higher for longer than other major economies as well. So the underlying dollar story remains fairly bullish. Clearly, the incoming administration and the incoming president has said in the past that he doesn't want to see a strong dollar. He needs the dollar to ease off. So obviously, there's been a lot of talk about a potential new Plaza sort of agreement to somehow deal with the strong dollar. But certainly for the moment, the outlook for the dollar remains pretty bullish. It has moved a long way, and it is certainly trading more certainly on the expensive side historically. And then vis-a-vis, what does that mean for the underlying US bond markets? Again, as we've said, I think rates probably in the very short term have moved up a little bit too quickly and too high. And as we discussed, there is a potential for them to ease off a little bit. But until we get more policy certainty, it's likely that the longer term US rates will remain elevated for some time longer.
Got it. Jonathan, great talking to you. Thanks so much for taking the time out and being with us. Really appreciate your time. We'll keep an eye out for the data today. And Jonathan, we'll look forward to talk to you post the Jan 20th event is out of the way as well.